What if I told you that in 2026, one corner of the real estate market is set to outperform all the others, creating a modern-day gold mine for investors who know where to look? While most people are still stuck on traditional properties, the smart money is quietly pouring into a sector that's ready for explosive growth. Look, the entire real estate world is hitting a giant reset button. The days of easy money and prices only going up are over. Higher borrowing costs, a shaky economy, and huge demographic shifts are making it a minefield for uninformed investors. But for those paying attention, those same challenges are creating the single biggest investment opportunity we'll see this decade. In this video, we're going to put 2026's top real estate sectors head to head. We'll break down the unstoppable trends driving them, look at the numbers that have Wall Street buzzing, and expose the hidden risks that could wreck your portfolio. And I promise you, the winner is going to surprise a lot of people. So stick around, because by the end of this, you'll know exactly where the smart money is going in 2026. Before we size up our contenders, we need to understand the new rules of the game. The 2026 housing market isn't about a simple boom or crash. It's more of a great reshuffling. We're seeing a fragile recovery where homes are getting a little more affordable, but it's a slow crawl. Forecasts show mortgage rates will likely land around 6.3%, which is a slight relief, but still a big hurdle for many buyers. Still, NAR's chief economist, Lawrence Yun, is predicting a potential 14% jump in home sales for 2026, which would be a huge rebound. In an environment like this, just buying a single-family house and crossing your fingers is a gamble, not a strategy. Winning in 2026 takes a surgical approach. It means looking past the obvious and finding sectors that are powered by irreversible megatrends. The annual Emerging Trends in Real Estate report, a joint project from PwC and the Urban Land Institute, points to a clear shift. Investors aren't just betting on location anymore, they're betting on innovation, demographics, and technology. This brings us to our four contenders for the title of 2026 Real Estate Gold Mine. We've got the old guard, multifamily housing. We've got the disruptive challenger, build to rent. We've got the demographic titan, senior housing. And finally, the technological backbone of our entire economy, data centers. Let's get them in the ring. First up, the sector everybody knows, traditional apartment buildings. For decades, this has been the go-to for investors who want steady cash flow and reliable growth. And on the surface, the argument for it in 2026 is still pretty solid. The main driver is simple: the brutal affordability crisis in home ownership. With mortgage payments still sky high, more people are stuck renting for longer, creating a massive, stable tenant base. But here's where it gets interesting. After years of nonstop construction, a huge wave of new apartments is hitting the market. This has analysts divided. Some, like Realtor.com, see this new supply causing national rents to dip by about 1%. Others predict that strong demand will absorb these units, leading to modest rent growth of around 2.3%. So either way, the old guard is showing signs of strain, and that same wave of new supply that might help renters becomes a major headache for landlords. In hot Sunbelt markets that saw a building frenzy, the fight to fill units is going to be fierce, putting a ceiling on rents and profits. More importantly, multifamily is having a bit of an identity crisis. It's getting attacked from both sides. For tenants who crave more space and a single-family lifestyle, a powerful new option has emerged. And for a huge and rapidly growing part of the population, their needs are becoming so specialized that a standard one-bedroom apartment just doesn't cut it anymore. So, while apartments will always be a core part of real estate, their days as the undisputed champion might be over. It's a reliable workhorse, but in the 2026 race, we're looking for a thoroughbred. This brings us to our second contender and the fastest growing slice of the housing market, build to rent, or BTR. Imagine combining the business model of an apartment complex with the product of a suburban housing development. That's BTR. These are entire communities of brand new single-family homes or townhomes, all owned and operated by one professional company. Why is this sector exploding? It perfectly solves the biggest problem for millions of millennials and Gen Z. They want the single-family lifestyle without the crushing weight of a down payment and a mortgage. You get a backyard, extra bedrooms for a home office, and a sense of community. but with the flexibility and lower entry cost of renting. The numbers backing BTR are incredible. Big money investors are flooding the space. Occupancy rates are through the roof. And because these are new professionally managed homes, they command higher rents. For example, BTR communities of cottage-style homes often fetch rent premiums of 18 to 19% over comparable new apartments. Investors love this model, and the tenants, they're stickier. The average turnover rate in BTR communities is around 30%, far lower than the roughly 45% seen in traditional apartments. People who move into a BTR home stay longer, which means lower vacancy costs and more predictable income for investors. The risk? Scale and location. BTR works best in growing suburbs, but it takes a lot of land and cash to build a whole community from scratch. It's also a newer asset class, and as more of these communities come online, those eye-watering rent premiums might start to cool off. But make no mistake, BTR is a direct answer to a fundamental shift in how Americans want to live. It's not a niche anymore. It's a powerful contender that's reshaping the rental market. All right, we're halfway through, and we're about to get into the two heavy hitters, both driven by unstoppable forces. This is the kind of deep dive analysis we do every single week. If you're getting value from this and want to stay ahead of the curve in real estate, do yourself a favor and subscribe to our free weekly newsletter. It's where we share the data and insights that don't always fit into a video. The link is right below in the description. Now for our third contender, a sector whose growth isn't a question of if, but when and how much. I'm talking about senior housing. The engine behind this is the single most predictable and powerful trend in the country, the aging of the baby boomers. In 2026, the very first boomers will be turning 80, which is a major inflection point for senior housing demand. This isn't just a fun fact, it's an economic tsunami. Every day, thousands more Americans enter the prime age for this type of housing. For years, the senior housing market was actually oversupplied. That equation has completely flipped. According to data from the National Investment Center for Seniors Housing and Care, or NIC, construction of new properties has fallen to historic lows. In the third quarter of 2025, inventory growth was just 0.7% year over year, the lowest level since NIC started tracking the data in 2006. Think about that. The number of people who need this housing is exploding while the supply has ground to a halt. This is Econ 101 for a massive investment opportunity. As a result, occupancy rates have been rising for over 17 straight quarters. With NIC forecasting, they will surpass 90% by the end of 2026. One projection indicates the U.S. will have a shortfall of thousands of units by 2030 at the current building pace. And this isn't just about old school nursing homes. The sector is diversifying with new products like active adult communities for the younger, more independent 55-plus crowd. The challenge here is that it's a complicated business. This isn't just real estate, it's a mix of hospitality and healthcare. It requires expert management and deals with regulation. But for investors who can partner with great operators, the demographic tailwinds are undeniable. The silver tsunami isn't a forecast anymore, it's here, and the real estate market is profoundly unprepared for it. Our final contender is a sector most people don't even think of as real estate, but it's the physical foundation of our entire digital world. Welcome to the world of data centers. Every time you stream a movie, join a Zoom call, use an AI chatbot, or pull a file from the cloud, you're using a data center. These are ultra-secure, climate-controlled buildings packed with servers that act as the engine rooms of the 21st century economy. The demand for data centers is simply off the charts. The growth of artificial intelligence and cloud computing is creating an unimaginable amount of data that has to live somewhere. This has created a landlord's market like we've never seen. According to firms like JLL and CBRE, vacancy rates in North American data centers have plunged to historic lows, hovering between a tiny 1.6% and 2.3%. The demand is so fierce that about 73-74% of all new data center space under construction is already pre-leased, sometimes years before it's even built. The market size projections are astronomical. One report projects the global market will grow from around $347 billion in 2024 to over $652 billion by 2030. A stunning report from McKinsey suggests that keeping pace with demand will require a worldwide investment of nearly $7 trillion by 2030. The biggest roadblock, and therefore the biggest driver of value, is power. You can't just build a data center anywhere. You need access to unbelievable amounts of reliable electricity. As one expert in the PwC report said, power access is the new zoning. This creates huge barriers to entry, making existing, well-located data centers incredibly valuable. The risks are technical and expensive. These buildings cost a fortune to build and maintain. But unlike almost any other type of real estate, data centers are insulated from normal economic slumps. A recession doesn't stop people from using the internet. The demand is driven by technology, a force that never sleeps. So we have our four contenders: the reliable multifamily, the disruptive build-to-rent, the demographically destined senior housing, and the digitally essential data center. Let's break it down head to head. In terms of growth potential, all four are strong, but the sheer world-altering scale of the digital transformation gives data centers the edge. Senior housing is a very close second, thanks to its demographic certainty. In terms of risk profile, traditional multifamily is probably the safest bet, but it also offers the lowest chance for huge returns. BTR and senior housing have operational risks, while data centers have massive technical and capital risks, but are shielded from consumer-driven recessions. For barriers to entry, multifamily is the easiest to get into. BTR requires more land and capital. Senior housing needs specialized operational expertise. But data centers have the highest walls around them due to extreme power needs and complexity, making existing assets almost like fortresses. So what is the single sector set to outperform all others in 2026? While an incredibly powerful case can be made for senior housing as a generational investment, the 2026 real estate goldmine, the sector combining unstoppable demand, insane barriers to entry, and insulation from market chaos, is data centers. Here's why. Data centers sit at the intersection of technology and real estate, and technology is the single biggest driver of our economy. An investment in data centers isn't just a bet on real estate, it's a bet on the unstoppable growth of AI, cloud computing, and our entire digital future. The influential PwC ULI Emerging Trends report specifically calls out data centers and senior housing as the top sectors to watch. The historically low vacancy rates, below 2% in many areas, prove a supply and demand imbalance that's more extreme than in any other real estate class. While a new apartment building has to compete with other new buildings, a new data center in a power-starved market might have no competition at all. It becomes critical infrastructure. You're not just a landlord, you're a digital landlord to the most powerful companies on the planet. The world of real estate investing is at a turning point. The old playbooks are being thrown out, and the opportunities of tomorrow aren't where they were yesterday. While traditional multifamily is still a staple, the explosive growth of build-to-rent, the unstoppable demographic freight train of senior housing, and the critical need for data centers are where the smart money is flowing. We've crowned data centers as the 2026 gold mine because they represent a fundamental change in what real estate even means. It's no longer just about providing physical shelter for people. It's about providing the physical infrastructure for our digital lives. That doesn't mean you should run out and bet the farm on just one thing. A diversified portfolio is always the smart play, and the case for senior housing in particular is overwhelmingly strong for the long haul. But if you're looking for the sector with the most explosive growth and the strongest defenses for the year ahead, the evidence points overwhelmingly to the buildings that power our world. What do you think? Which sector are you betting on for 2026? Let me know in the comments below. And if you found this analysis valuable, hit that like button and subscribe for more deep dives into the future of real estate investing. Thanks for watching.